Welcome to International Taxation Inbound Transactions, presented by Northeastern University's DeMoore McKim School of Business. I'm David Hardesty, and I'm the lead faculty person for this course. No graduate course of study in taxation is complete without a thorough explanation and examination of the issues associated with the taxation of inbound transactions. The taxation of inbound transactions refers to the U.S. taxation of income earned by a non-resident alien individual or a foreign entity from sources within the United States. Inbound taxation encompasses all of the U.S. tax rules associated with the taxation of U.S. source business and non-business income earned by non-U.S. persons. Inbound taxation does not include foreign taxation of U.S. taxpayers. That topic is covered in a separate course of study titled International Taxation Outbound Transactions. The broad objective of this course is to give students a thorough grounding in the U.S. tax rules that impact foreign persons doing business in, selling products to, or investing in the United States. Our study is focused on the tax issues faced by non-resident alien individuals and foreign corporations. The following slides explain this objective in detail and explain the topics we must cover to meet this objective. First, let's go over the main objectives for this course. As I said, no graduate course of study in taxation is complete without a thorough examination of the issues associated with inbound transactions. The objectives of such an examination and the objectives of this course are to gain an understanding and a working knowledge of the following. The overriding objective is to understand a foreign person's tax liability in the United States. Whether your job is to advise foreign persons on their potential U.S. tax liability or to prepare tax returns for foreign persons, you need to know how to determine U.S. tax. To accomplish this overriding objective, we will study the tax rules applicable to foreign individuals who invest or do business in the United States. We will also come to understand the tax issues faced by foreign corporations investing in or doing business in the United States. In all cases, we will study general principles applicable to all taxpayers, including the identification of U.S. income and the requirements for U.S. withholding of tax on that income. And we will examine issues unique to specific taxpayers, such as determining when a foreign individual is a U.S. resident and the unique relationship between foreign partnerships and their partners. Let us turn now to the substance of our study. First, we must understand the areas of tax law that are common to all foreign taxpayers. The first area of tax law is the classification of income as either business income, non-business income, or exempt income. Another area of tax law concerns the question of whether or not the foreign taxpayer is engaged in the conduct of a U.S. trade or business. Not only must we know how to classify income, we must know how to determine the source of the income. Because non-resident aliens and foreign corporations are ordinarily taxable in the United States only on U.S. source income. We also need to understand the special rules for U.S. taxation of real property interests. Finally, we need to understand the law on how to determine whether the foreign taxpayer is eligible for the benefits of a U.S. tax treaty with the individual's home country, if any, and the way that the treaty affects a foreign taxpayer's U.S. tax. The first major topic that is common to all foreign taxpayers is the classification of U.S. source income as either business income, non-business income, or exempt income. The U.S. rules for the taxation of business income of non-resident aliens and foreign corporations are substantially different from those for taxing non-business income. In addition, certain U.S. source income is exempt from U.S. tax when earned by these taxpayers. Therefore, it is necessary to properly classify income as non-business, business, or exempt. Non-business income is usually limited to dividends, interest, rents, and royalties. However, we can also classify certain other fixed, determinable annual or periodic income as non-business. Non-business income is taxed in the United States at a flat 30% rate, unless a tax treaty applies, and no deductions against this income are allowed in calculating this tax. Business income is usually all other U.S. source income that is not non-business income. Business income is taxed in the United States at the regular graduated tax rates that apply to U.S. citizens and domestic corporations, and all applicable deductions are allowed against this income. Certain income is exempt from U.S. tax in the hands of non-resident aliens, foreign corporations, and foreign partners. For example, these taxpayers are usually exempt from U.S. tax on many kinds of interest income and on capital gains. However, as we will see, capital gains from sales of real property are not exempt from tax. The next topic of study is the existence of a U.S. trade or business. A non-resident alien or foreign corporation is usually taxable in the United States on business income only when that income is effectively connected with the conduct of a U.S. trade or business. Ordinarily, we have to know when a U.S. trade or business exists. Note that a U.S. trade or business is not necessary for taxation of non-business income. It is only necessary that the non-business income be sourced in the United States. Source of income is the next area of study that is common to all foreign taxpayers. In general, the United States taxes a foreign person only on income that has its source in the United States. This rule applies to non-resident aliens, foreign corporations, and foreign partners. Different sourcing rules apply to different types of income. The major categories of income to which specific sourcing rules apply are as follows. Inventory sales, rental and lease income, sales of personal property other than inventory, royalties and similar fees from the license of intangible property, and income from personal services. The corollary to the source of income is the source of deductions. Here we are talking about only deductions relating to business income, since no deductions are allowed against non-business income. Most of the deductible expenses of a foreign taxpayer are allocated between U.S. source and non-U.S. source income pro rata. However, special allocation rules apply to many types of deductions. We will focus on the special rules applicable to deductions for compensation and fringe benefits, research and experimentation expenses, and interest expense. Special rules apply to the income from the rental of or gains from the sale of U.S. real property. These rules override the general rules for the taxation of business, non-business, and tax-exempt income. In general, U.S. real property rental income that would normally be treated as non-business income may be treated as business income. When it is, the foreign taxpayer is able to deduct expenses against the income for U.S. tax purposes, and the net income is taxed at regular U.S. tax rates. Capital gain, which is ordinarily exempt income for a non-resident alien, foreign corporation, or foreign partner, is taxable in the United States if it results from the sale of U.S. real property. And finally, special income tax withholding rules applies to sales of U.S. real property. The final area of study common to all foreign taxpayers is U.S. tax treaties. The first topic is whether a tax treaty applies to a particular foreign taxpayer. The United States has treaties with around 60 countries, so it is first necessary that the foreign taxpayer is from one of those countries. Then it is necessary to know if the taxpayer is eligible to use the treaty of the taxpayer's country. In certain cases, even if a taxpayer is a resident of a country with which the United States has a treaty, that taxpayer cannot use the benefits or claim the benefits of that treaty. Finally, we have to determine how the particular tax treaty applies to a particular transaction. All treaties have differences, some minor and some major. The most significant effects of tax treaties are as follows. Business income must be attributable to a permanent establishment in the United States before it is taxable. This is a higher standard than the one discussed above, requiring business income to be effectively connected with a U.S. trade or business. The tax on many types of non-business income is reduced or eliminated under U.S. tax treaties. And tax treaties can have the effect of exempting a non-resident alien or foreign corporation from all U.S. tax. The final issue common to all foreign taxpayers is income tax withholding. The understanding of the U.S. rules associated with this issue is the final major objective of this course. There are three significant areas in which income tax withholding is required with respect to foreign persons. The first is income tax withholding on non-business U.S. source income. The second is income tax withholding on income from the disposition of U.S. real property interests. And the third is income tax withholding with respect to foreign partners. There are also three issues that apply to these kinds of withholding, and we will study each in detail. The first is the type of income subject to withholding. The second is determining the person responsible for withholding and remitting the tax. And the third is claiming the benefits for withholding by a foreign person. So there you have it, a complete outline of the objectives and topics covered in this course. You should next listen to the lecture on the operation of the course. However, before moving on to that lecture, let me make a few comments on the importance of understanding the taxation of inbound transactions. Cross-border transactions between businesses or between businesses and their customers have been increasing rapidly ever since the fall of the Berlin Wall and the end of the Cold War, over 20 years ago. The rise of electronic commerce as a major component of international transactions around the turn of the century accelerated the pace of cross-border buying and selling. With the United States, the world's biggest consumer of goods and services, the amount of inbound transactions is huge and growing. It would be very unlikely that a tax professional would not have to face tax problems associated with one of these transactions. The price of not knowing how to prepare a tax return for inbound transactions or how to advise a foreign client on U.S. tax treatment of such a transaction can be great in terms of tax penalties, lost planning opportunities, and unhappy clients or employers. So this course is an absolute requirement. I want to welcome you to the class, and I look forward to a fast-paced but fulfilling 5 weeks as we explore this fascinating subject.